Hello and Assalamu alaikum. I am Daniel Kamal, and today with my colleague Zainab Basil, we have the unique opportunity to interview the founder of Tez Financial Services, Naureen Hayat. Tez Financial Services is Pakistan's very first fully digital non-bank microfinance company, which serves the underbanked population within Pakistan. Tez is truly a pioneer in its field. So, without further ado, let's hear what Naureen has to say about microfinancing and why it is the need of the hour.
Microfinance, guys, I think there are two parts to microfinance. One is the conventional microfinance, which is how microfinancing actually started, the conventional model on the field. Um, Now, in Pakistan, that sector was actually created with the mandate to reduce poverty, to alleviate poverty. And you have the conventional microfinance institutions and the microfinance banks that actually operate with a model that is similar to a lot of other microfinance models that you see around the globe, which actually started with a group lending based model, and then that evolved to an individual lending based model. But the essence really there was having a group collateral. And what is a group collateral? It is actually a social collateral that's used to make sure people repay. Now, those loans have varied in size, and right now the average loan size in the microfinance conventional field industry stands at around 45,000 rupees. um, and that sector has actually evolved ever since it was created in 2000 to now. You have now about 40 odd microfinance institutions and another 10, 11 microfinance banks who are operating in the field. But what's happened is, well, if you look at it in the past 2 decades, the microfinance sector has been able to tap about 7, 8 million borrowers, which literally is a very small number now that we look into in these past 2 decades. Um, and what we see is the kind of penetration that it was expected to achieve. It hasn't really been able to do so. So literally stagnated at a point now. There have been various criticisms around the sector, primarily in terms of high interest rates. But I think that's not because the sector itself is deliberately charging those high interest rates. It's the kind of market, the risk that the sector entails, and the operational costs that the sector has to incur to actually reach the masses, which is why these interest rates are usually higher. Which actually takes me to the next part. Now, microfinance now, in a way, has evolved, and now there's tech that's come into the play. If you really want the sector to evolve, and you want a larger market to be penetrated into, there has to be technology involved. um, so what we actually look into, this is how we term it. So there's literally microfinance 1.0 version 1, which was actually on ground. Then it evolved into what we call branches banking, which you could term it microfinance 2.0, which is where you have the branches banking providers such as Easy Pesa, Jazz, Omni, and the likes. And the mandate really there was to get people to transact digitally and to get into areas where otherwise it was tougher even for field operations to operate. So that's how it evolved. Now, the next generation of microfinance is evolving, which is where we come in as Tez, is the digital side of things. And that's really why Tez came into being. And I think we, at least in terms of how we envision ourselves to be, or the mandate with which we started, are very different from other fintechs in the play. Because for us, the story really started with field microfinance and the challenges that field microfinance was facing. And so technology literally was a medium for us to capitalize upon to reach the masses in a more effective manner. Um, and why we actually came up with this model of using technology was, number one, to have access to other forms of data that otherwise conventional microfinance institutions or even otherwise banks don't have access to. Alternative data provides you access to that. So we use smartphones. Smartphones literally, you know, ev- 80 million people in Pakistan have access to a smartphone. And so banking on digital is a very, very powerful tool of integrating the masses into, the financial net. And so I think this is the next generation and the current generation of microfinance as we see it, banking on technology to bank the underbanked or the unbanked. So yeah, that's a bit about microfinance, and if you want to get into the nitty gritty of it, I can answer a little more around it.
Yeah, I think that covered pretty much everything that we wanted to talk about. So just based on your answer, you talked about the sort of automation that occurred within the field and how you sort of had the opportunity to capitalize on that. So, do you think that was sort of the core motivation behind initially starting Days, or would you say that that was something more than that?
Okay, so Teja's journey is actually pretty interesting. So you know, when I was working with PACRA, the credit rating agency, my co-founder now, Hamza, we both were working there, and we happened to be specialists for the microfinance sector. And while we were studying the sector, as I mentioned, one of the core issues that we saw the sector actually entailed was having high interest rates. Now, these high interest rates primarily trickle from high operational costs and high operation inefficiencies in the field. So you have field officers who are a very integral part of mobilization, lead generation, and ultimately the entire process, credit disbursement process till till post disbursement monitoring. So what we saw was, in order to address this issue, it was important to eliminate the high operational costs. And so we came up with a technology which was at that time, that was our first startup actually. It was called Check-in Solutions. And it was a digital field application that literally it automated the entire credit disbursement process, right from lead generation to post disbursement monitoring. That it was more of a B2B model. We went on to talk to almost the entire microfinance sector. And interestingly, we got a lot of interest. This was back in 2014-15. I think we were a little ahead of our times then, because although there was interest, but I think so microfinance institutions either did not have the budgets for technology or the mindsets to adopt technology. These past 5-6 years have literally flipped the mindsets, or at least gotten people thinking more around technology, which is why they've become more conducive to the idea of adopting technology. So Tez actually came. It was actually so how it evolved was that when we were actually working to get check-in enrolled into the sector, we got in touch with Nadeem Hussain Saab, who's also a co-founder at Tez. And that's when we took him on as an advisor. And we then actually decided to, in a way, pivot the idea from a more B2B model to actually developing our own microfinance institution to reach the masses. And so that's how the idea of Tez, really evolved.
Okay, yeah, that sounds good. So while you talked about, building up your own model as well, as far as we've looked into it, your consumer base is very non-traditional, right? So you operate in like this sector that's more based on like Kirana stores, etc., where the risk is also relatively higher. So why did you decide to choose this particular segment?
So I think it's very important to know now, currently, if you talk about the conventional banks, um, they are very, very risk averse in terms of the sectors or the segments that they target. Even with microfinance institutions, they do address relatively riskier segments, but their model is very different. So why we actually decided to cover those segments is because no one else is really serving them. And the reason why no one else is serving them is because number one, they don't have credible data, they don't have suitable collaterals, um, and they don't have credit histories. Only 1 out of 10 people in Pakistan actually have a credit history or are registered with a credit bureau. So that literally is a no-go area for most of these conventional formal financial institutions. And our technology basically banks on the digital railroad. So we decided to, use the smartphone. Now, you know, as I mentioned earlier, over 80 million people in Pakistan have a smartphone. And this smartphone actually provides you rich insights into a person's daily lives. It provides you access to your social demographic data, your financial data, your geographic data, your consumption data. And so we actually decided to bank on this data, and really circumvent the need for data or the need for or even collaterals or credit histories for that fact, yes, definitely we were taking and still are taking on that risk. But that's the only way to create credit histories for the masses. And so we started lending out small, building those credit histories for people, loans that range between 1 to 10,000 rupees. And what's groundbreaking here is that we actually disperse these loans in a matter of literally 10 minutes, right from the point of download till the point that the funds actually into someone's wallet, as opposed to the 30 days or so that banks take, in case of microfinance institutions, about a week, 10 days at least. So that's why we actually are and how we're targeting this segment.
Okay, right. So, while you talked about how, like a lot of people actually have a very inherent lack of credit histories. So, I just wanted to sort of get a feel of how you then draw that line, right? So, how do you determine that the market is, that financially literate that they even are able to use Tez's services optimally, even though they're like as basic as possible? But yeah.
Yeah, that's a very important question. So I think literacy is definitely a major element, fundamental, that needs to be covered. Um, and there are two sorts of literacy that come into play when we talk about this. One is financial literacy, and another is digital literacy. So I think digitally, we do see people are definitely much savvier than we feel that they are. And the segments that we talk about, surprisingly, to our surprise, they are definitely much more savvier than we are with smartphones at least. In terms of financial literacy, we definitely have had to work on that, with our customers and people who come on to download the app. There's definitely an element of trust that comes into play when you begin, number one, with getting people onboarded. They have to share their data, they have to share their KYC details. And so we've had to build that brand equity, and that trust, in terms of being a registered and a licensed financial institution, to get people to know, okay, this is something that's credible. I think what's helped us is, because we started off with lending, um, you know, we were actually giving out money, which meant that people were definitely much more conducive to the idea of trusting us, because here they were on the taking hand and not on the giving hand. So that actually helped us build that credibility. Uh, and definitely, in terms of literacy, we focused a lot on financial literacy campaigns and brand awareness in our social media campaigns, and even in our customer journey. At every point of the journey, we try to educate the customer in terms of why he or she has to take this particular step. Um, in terms of a customer support, we have call to actions on each of our screens, explaining people why they're sharing what they're sharing, or what the next steps would be. I think, but the next element actually comes down to the recovery bit, and that's a tougher one. And definitely we've had people who've actually come on and defrauded us, because the intention from day one was actually to default. uh, but that's actually primarily when we started off, because that's when we were building our algorithms, or we did not have our algorithms when we started off. But we actually learned from the fraud, the customer behaviors, the customer uh, patterns. And now with time, our algorithms are at a stage where they're much more robust in terms of actually identifying who to lend to or who not to lend to, based on their digital footprints. So I think that's something that we've actually had to educate the masses as well. In terms of recoveries, we send out SMSs. We have an entire delinquency management system where we send out SMSs and push notifications, telling our borrowers what the advantages of early repayments are, or what the repercussions of late repayments are. So there's an entire journey, an entire focus on that bit of financial literacy, and I think we're still trying to cover that. It's going to be a very long journey. We can't say that we will be able to address that concern from day one. We are literally market makers here, and I think earlier entrants have to take on the brunt of that. It's a responsibility as well. And then, of course, the entrants that come on, they have it relatively easier because the market makers have set that stage. For example, Easy Pesa was, well, I'd say Omni. Both of them actually were the ones who actually came into the market with branch banking. About 10, 15 years back, people didn't understand what a mobile wallet was. They didn't understand how to transact with mobile wallets. Now, people are much more conducive to the idea, and they understand that much better than what they would have otherwise. And so, people like players like Jazz and Sim otherwise are now taking advantage of that. So I think we as early entrants have that responsibility to play as well, and definitely it will take time.
Thank you, Noreen, for that great introduction. So let's talk about the business model and the risk aspect of this entire of this financial. So, could you maybe in a brief words, in a few words, explain to me like what your revenue generating model is? Because I would assume that traditionally you do operate on that interest basis, and it's basic arbitrage. You lend out money, you take it back with interest, and you get that sort of revenue chunk. So maybe if you could walk me through the revenue making process.
Sure. So Tez it's a full stack neobank. Well, literally not a bank because in Pakistan we don't have digital banking regulations. Um, but in terms of how technically internationally you call it, we are a challenger or a neobank, and lending or credit is definitely a flagship product. But we also have other products on the slate, which includes savings. And I'll come back to what really saving entails, insurance and investments. So it's literally a full stack neobank for the masses. In terms of savings, we don't do conventional savings. We are digitizing the way informal savings in Pakistan are really conducted. So, as you all know, committees is one of the most common means of savings. It's second only to saving at home. So about 50-60% people of Pakistan save at homes. And then about 30% people save in committees. So we have digitized the entire committee process, and this is a product that will be going live soon. And so that's one of them. The other one is fractional gold, which is a very interesting product under development right now. And what people can do here is they can come and save in gold as low as 100 rupees. So we've actually developed this with ARY, and this is something that we hope to launch within the coming months soon. Now, in terms of our flagship product and where the core revenue generation comes from is the credit product. And as you rightly mentioned, so what we do is these are very small, they're nano loans. So these are loans between 1,000 to 10,000 rupees, short tenors, ranging between a week to 2 months. And we actually charge, yes, a fixed fee on it. But what's different here is we do not accumulate the interest, as you would call it. So just a one-time charge. The only charge that would actually be incurred to someone who's late or who's defaulted is a very small late payment charge, which also is not accumulated. So that's literally how we monetize our revenue. Um, but of course, there are definitely costs that come to it, and this is literally it's a game of volumes because these loans are so small. And yes, there are costs that come into play. There's of course cost of funding. There's the major one is the cost of default that initially was much higher than what it is now, and then the operational costs. So that's how the model really operates. And as our defaults are going down, we are getting more into the greener as we speak.
I'm actually glad you brought up this idea of cumulative or compounded interest. Before this, you mentioned that usually in the traditional sector, banks usually charge very high interest rates because of the trickle down effect of high operational costs. So, from my understanding is that Tez Financial does not have that much of a high operational cost. So that is why you might be able to charge lower interest, or you might not go into that area of compounded interest or cumulative charges.
Well, I think, Daniel, that's not entirely correct. So initially, when till you actually reach a particular threshold volume, um, that operational costs will definitely be higher. So those economies of scale actually come on when you start lending to much higher volumes. Um, and for now, the costs are higher primarily. So when you talk about operational costs, the cost of technology initially is higher because you have large elements of, for example, hosting that comes into play. Hosting, so as financial institutions, there are requirements on us where we cannot host financial data of customers outside of Pakistan, which means that you need to host it on a local cloud. And local cloud service providers are very expensive. If you talk about, if you compare it to international who are hosting service providers, it can vary anywhere between 7 to 10 times the cost, unfortunately. I think they're also now working on trying to build those economies, but right now they haven't reached those. So they're passing on the cost to us for that matter. So those costs, the operational costs for now are higher, but as we're growing our book and we're getting more and more customers into the platform, those economies of scale will definitely be transferred, to the customers in terms of low interest rates, and that's a very important a point here. So we at Tez, we work on risk-based pricing. Um, the point here is really to pass on the benefit to the customer if they're actually exhibiting good repayment behavior. And that's what we're already doing with our loyal good customers. The rates actually go down as they graduate to higher loan sizes. So that's something that Tez is working on, and we're focusing on it.
All right. Thank you for that. So my next question to you is that, so what Tez, in my understanding, is a digital platform for lending, basically a neobank in your own words. So the thing that I'm concerned about is that, is there a specific trade-off between digitalization and risk? Because what you're doing is you're essentially making usually a hassle process a very hassle-free one, or you don't take that kind of information. You don't spend a month securing a loan for 10,000 rupees or even like 5,000 rupees. It's a 10-minute process in your own words. So do you think that there is a specific trade-off in this, like having a faster process versus the risk that you're incurring?
And that's a very good question, Daniel. So I think uh, I actually like to divide my response to that. So one is the customer journey side of things, and the other one is actually the credit risk. Now, what technology has actually helped us do is really make a very seamless customer journey, which means that now, people who are actually sitting in their homes and otherwise could not have access to the bank, or did not want to access a bank because did not have the kind of product that they needed or matched their needs, are now being served to them at the comfort of their homes. So we focus very much on the customer journey side of things, and how we actually look at it is there's definitely high touch, but with that high touch, no, there's definitely high tech, but with that high tech, we want that high touch element, and that we try to mimic through a seamless customer journey. So tech definitely has helped us strengthen that the access or our connectivity with the customer. And with time, we're definitely evolving the process, to make it even more conducive and seamless for the customers. So I think that definitely has been easier, or at the advantage, I'd say. But the second bit is the credit risk side. And so the point of technology here is, I think technology can play a very, very strong role. Um, but there are no standalone pieces, or you can't look into any one particular piece in isolation here. Because if I say that algorithms alone will serve the purpose of financial inclusion in Pakistan, they will not. Even algorithms need time to learn. Even algorithms need money to be burnt to learn. And of course, they need a lot of business intelligence to go into it. So if I say from day one that technology will serve that purpose, no. Just to give you an example, and now I think we talk about this to a lot of people. But initially, when we started lending, we lent blind, which meant that we did not have any business rules in place. We did not have any algorithms in place, and that was deliberate. And why we did that was actually to learn from how customers really behaved. And we got massive amounts of defaults, but most of default actually came in from fraud, people spoofing their identities. So that was a major cause, major cause of risk that we saw coming in. And and literally that was gold for us. We had to burn money, but it came with a cost, but it literally was gold. So that's how we evolved, and that's when we actually created our business rules. We formed the first um, version of our algorithm, and it evolved with time. It evolved over cohorts. Now, what technology has helped us do really is understand the customers better, and we're doing that by the day. It is evolving. It will take time, but not only are the algorithms evolving, but also our business intelligences, and that's something that we are embedding within our systems. But I think what really matters here is the overall ecosystem as well. So, having a great app, having a great algorithm definitely is something that we internally, are trying to work on, and we have seen success in some aspects, but then there is an entire other domain that you need support on, which actually comes in from the ecosystem. And when I talk about that, we talk about players like Nadra, for example. Uh, so, for example, digital identity it plays a very crucial role here. So you need access to those additional data points to be able to capitalize on your technology infrastructure better. Another very important element that I speak of a lot, and we have other players in the ecosystem speaking of, is having a centralized KYC, which means that you have more and more data points on those customers from other people who've actually banked them, to understand how the customers are behaving, so that KYC comes with a lower cost, and also with a lower risk element, because they're it's actually accredited by other institutions who serve them. And then there other aspects of credit bureaus here, trying to work on centralized credit bureaus, which are also cheaper in terms of inquiries. Currently they're very high costs to even something like a Veritas with Nadra, or a credit inquiry with with the credit bureau. So all these elements actually play a critical role in enabling the entire technology infrastructure for the sector. And I think we still are at a very nascent stage. We are evolving. You have initiatives like RAS that have come into play, and they're very important and very powerful tools in the segment. But how we actually capitalize on it, and how it opens up to the sector, is something that is important and will help create that trade-off between that risk and technology that you just spoke of.
All right, that's actually a very holistic view onto how things work. So my next question is, in one of your videos, I saw you talk about that you now have collaboration with banks and insurance companies. So my question to you is that you serve a sector which the banks do not serve. So like, how do you get the banks to come on board when you are taking that sort of risk, when you're going into the areas where banks usually do not want to go? So could you maybe go through that?
Okay, so we have two sorts of partnerships with banks. On one side, we have banking branches, banking partners on who help us support on the payment side. So this is not a payment player, and that's a deliberate reason why we didn't get into it, because we have enough players in the market who are working on that payment. So we decided that we are actually going to build a layer on top of the payment layer that's created. And the reason why we see payments hasn't really kicked off the way you want it to kick off is because you do not have enough use cases on that payment layer. Now, those use cases actually come in from people wanting to use digital because there's a need that needs to be served. So for us, for example, credit is that it's a low hanging fruit. Anyone, it's actually easy. It's an easy sell, and it'll actually attract people to actually start using that payment railroad. So when you talk about banking partnerships, one, we are actually with our payment partners, we're encouraging people to open bank accounts or wallets for that fact. 65 to 70% of the people who are on Tez's platform never had a bank account before this. So we literally have banked those people. So, you have bank accounts being created. And at the same time, you have transactions within those wallets, which is something that payment providers, that's their bread and butter. And that's what they're focusing on. So we're actually encouraging banking transactions or activity within those wallets. So that's one of the reasons why, that that leg of the banks want to work with us. The other sorts of partnerships that we have with banks are in terms of more of product partnerships. And with those partnerships, we're actually providing. Okay, now one is our credit scoring piece, which is the algorithms, and our business intelligence, which is where we're helping banks understand. This is the kind of customer that you want to lend to. This is the kind of customer you don't want to lend to. So that's where our analytics comes into play. And the other side is where we actually have, different sorts of model where there's risk sharing as well, where we do balance sheet sharing. And that's something that's evolving now, where we do take on shared risk on the balance sheet on customers. Now, when you say banks are not looking at those segments, yes, to a great extent, they haven't so far looked at that segment. But with time, you actually see banks wanting to grow their bases, and to grow their bases, they will have to serve those segments, and they understand that. And that's where we actually come into the play to help them out. So we're literally creating credit histories for the banking sector with the kind of loans that we're giving. And once those credit histories are built, banks are also much more open to the idea of lending to the segments, because now they have a credit history. Now there's data on them. And we plan on graduating customers to higher loan sizes with our banking partners, which otherwise these as a decision is not doing, because we're focusing on smaller ticket sizes. So that's how and why banks are partnering with us.
So I just have a quick question here. So as far as I can tell, the model is sort of how you like how Tez functions as a sort of link between this consumer base and then these bigger banks, right? But then wouldn't you also say on the flip side that you're sort of introducing this consumer base directly to banks, and because of that, you're inducing competition for yourself?
Very interesting, Zainab. So yeah, see, I think of it a little differently. Maybe conventionally, yes, there is competition, but you have a market that's 150 million people. Um, and I think there's enough room for everyone to actually come into this play. So I think for us, at the end of the day, there's enough for everyone in the pie. And yes, we will be creating that competition base as well. But how we look at it is that via these partnerships, we're actually eliminating that competition. Um, and that actually is also very deliberate, because yes, we see competition coming in primarily from the telcos, who actually have access to much more data and a much bigger subscriber base than the banking sector does. And how one can circumvent that competition is actually partnering with the banks and building those bases that both can actually capitalize upon. So I see this as more of a symbiotic relationship than a catabolic one. And I think right now it's too soon to actually start thinking competition. I think this is actually literally the time where you need more collaborations to come into play, for the masses to really benefit. And I think with banks as well, the kind of products that they offer are very different right now, at least from what we're offering. They also have their own mandates, and they also have their own policies in terms of what they can or not, provide to the customer base. So there's certain risk they can take with certain regulations under the state bank. They have strict policies and procedures which otherwise might not allow them to serve the kind of segments that we're serving right now. So there are definitely those elements that come into play. And when you talk about the other sorts of products that one could upsell the customers that we're bringing to them, that's a very different sort of a product domain. For example, you talk about you know auto loans, you talk about higher consumption loans, you talk about housing loans. So I think those are areas that we right now at least are not operating in, and that I think that comes in with a very synergistic approach that we look at.
All right, so just a bit of a clarification for our audience. So basically, the way normally a bank works is that you have deposits, you have a reserve ratio, and on that mathematical working, you give out loans. So so how does Tez Financial give out loans? Do you have a pool of money with you, or do you work on deposit? Because I know you're introducing this idea of committees, and that would give you a kind of a temporary cash bank, if you will, to your company. So maybe from that, could you maybe explain what is the source of these loans?
Well, so Tez is not a depositing entity. We are a lending NBFC, which means that we're not allowed to take in deposits. Um, so our sources of funds actually comes in in two ways. One is debt or equity, or in some cases grants. Um, and how we focus on it is, yes, we have used our own money, the equity that's been invested in this, but at the same time, we've also been able to raise debt. So we were the first fintech in Pakistan to actually raise debt from, conventional debt funders in Pakistan. So yeah, in growing a loan book, and this is how globally as well, digital lenders operate, is that a large segment, a large pool of their funds actually comes in from debt, which is actually used for on lending. So that's how we are looking into the model right now. Um, in terms of committees, something that I'd like to highlight, we cannot and will not use the committee funds for on lending. That money is strictly ring fenced only for the purpose of the committee. So we cannot use that deposit. But yeah, so that's how the model operates right now. But the challenge of this model is that you will have to keep on raising funds, particularly on the debt or the equity side. And for that, we again have partnerships with banks where that balance sheet sharing model comes into play. And so I think that's how we are looking into it. And yeah, we hope to evolve this further. So I think this is just the very beginning, and um, there are funds that are coming in that will continue to flow into the segment if it has to grow. That's how it has to grow.
So, in terms of your audience right now, I think you are mainly concentrated in the areas of Punjab and Sindh. So, do you have a plan in how to expand towards KPK and Balochistan as of now?
So we are currently in over 160 cities in Pakistan. And interestingly, about 30 to 35% of our customers are in tier one cities: Karachi, Lahore, Islamabad, other tier one. The majority actually lies in the peri-urban rural areas, or tier two cities and otherwise, tier two, tier three cities. So we are already in, well, anyway, where there is smartphone penetration, Tez is already there. And this happened very organically. So we haven't really focused on which geographies we want to target. Of course, through our digital marketing, there are certain preferences that we look for. But to our luck, we've seen loans being taken right from the beaches in Karachi till the borders of China. Yeah, so that's how it is.
That's actually great to hear. I mean, like the internet penetration is an important variable when it comes to your business model. So one of my last questions is it's actually based off a paper that I read by Abhijit Banerjee. So he did a study on these microcredit agencies within 6 different countries. And the crux of that paper was that basically when you take everything as an aggregate, from a consumer point of view, there's no substantial improvement in their lifestyle when they take out these small micro loans. I mean, he did studies in India, in Ethiopia, and other regions as well, and he said that this is a very good profit making model for the businesses. But from a consumer standpoint, from a person who is borrowing that money, there's no substantial or statistically significant improvement in even in household income. So my question to you comes basically this is what kind of message are you trying to send with this financial?
Okay, so this is actually quite an interesting debate that happens in the microfinance space globally. There have been various studies that have been covered on it, and I think there are two thoughts to it. And I think one, definitely, when you talk about the standard of living, that's a tough one, because maybe for a major part of how and why those loans were taken, they did not have an impact on the standard of living of people, and that's what a lot of researchers allude to also. But I think another very important aspect is the access part of things. Now, the purpose of why that loan is taken is very important. And if you talk about the microfinance sector and the mandate right now, majority of these microfinance institutions do not lend for consumption. They lend for productive purposes. Now, it's a completely different story whether or not those loans are actually used for productive purposes. Many times they're not, which is why the impact that it's meant to achieve is not achieved, because that fund isn't really put into businesses or productive purposes that would otherwise accrue revenue generating lines for those borrowers. So, that's definitely an area that we understand does exist. But in terms of, you know, I think a very important aspect that I meant to in terms of access is that the informal sector that these borrowers otherwise avert to avail lending, they they're literally loan sharks. They charge interest rates as high as 200, 300, in some cases even 500%. Um, and there are lots of other challenges that come into play in terms of accessing those kind of funds. So definitely, I think the microfinance sector has played a very critical role in bridging that access gap. And I think that comes in with dignity and privacy as well. Now, in terms of how and why those funds are used and whether or not they actually help people, transcend to the next level of their socio-demographics, pyramid, that's another area. And I think that's what a lot of practitioners are trying to focus on. Um, with these, for example, we are in a very, very different niche of microfinance, and we started off with consumption lending, which is riskier, yes, but it's also the need of the hour. Because right now you have customers, and if you talk about impact, I'll just share the impact that we've achieved. We Majority of the loans that have been taken from Tez have been taken for medical purposes, medical related purposes. Even if that means going to a medical facility, or the travel that goes into it, the medicine that one purchases, or the fees of the practitioners. So that's one of the areas. Then there's a huge segment that actually avails loans from us for micro entrepreneurial purposes. And these are very, very small micro entrepreneurs who actually get those loans to purchase their inventory. And these are like, little mom and pop stores. Chote jo dukandar hote hain, they're actually the people who are actually coming to us to get these loans. So we're actually providing them that day-to-day working capital to actually build it. Now, assessing that impact or measuring that impact is something that we haven't done, honestly. Um, and that's something that we are now focusing on or trying to do. That's something that recently started out with the financial literacy campaign that we started. But that measuring that impact is a tough one, and it's not a short term project. It literally requires years of study to actually see what impact those funds actually having on people's lives. So that's how we're looking at it. And I think, in some cases it might be true, in some cases may not be true. But yeah, I think that's at least the vision that we're coming in with.
Those are all really interesting points. So one thing that I want to ask, it's kind of my observation, is that when you talk about microfinancing or giving these micro loans, I think that an important piece of the puzzle which is missing is actually financial literacy on how to use those loans effectively. Because like there are multiple different segments on how people use loans. They use for medical purposes, even education, and sometimes just consumption based. So I mean, do you think that there's a lack of financial literacy and there's still like something to do about that so that people can actually have an impact when they take out these loans and how they use them effectively?
Yeah, I think that's a difficult ask of someone who doesn't even have funds to pay for their next meal. It's a very difficult ask. Honestly, um, we, in terms of financial inclusion, I don't think have reached that stage where we can even, you know, I'm not saying it's wrong to think about it. I'm not saying we should not focus on that part of literacy, but it's a tough ask, from a customer to ask them to get funds for some another purpose when they actually need it for literally the first level of the actualization pyramid. Um, and I think wherever the need is, that's why someone would come to you. And if that first need is not being met, it does not make sense to actually start thinking of the more evolved upsell need. So for us, if we can actually address that concern of the customer, where we're actually helping people pay for their groceries, where we're helping people to pay for their medicine or their school fees, for us, I think that's impact enough. And for the customer as well, I think that's purpose served enough. And I think that's when they actually will evolve to the next cycle or the next stage of the pyramid where they can actually start using those funds for probably more evolved needs. Um, but to your question in terms of literacy, I think literacy definitely is needed in terms of how to, for example, save, how to budget, how to utilize those funds efficiently. And that literacy is something that we're also trying to focus on. And we recently launched a video series, in partnership with the knowledge platform JICA and the Women Development Department of the government, where we are actually literally addressing the grassroots. And this is a six video series where we're talking about, aspects like budgeting, saving, opening a wallet, how to open a wallet, and so on. And we'd be happy to share this with you. If you want to share with your partners, go ahead. The point is really to get people understanding what financial services are all about, and that too definitely is important. I wouldn't undermine the significance of that, but yeah, I think that's how I would think about it, and that's how at this, for us, that's what a customer needs at the end of the day.
So thank you for that. Just a few specific questions that I had. So basically, when you start giving out loans, do you give more than one loan to one person if they haven't, like, do you give them recurring loans if they haven't paid back their original loan, or do you just like say, कि, अच्छा आप पहले ये loan लो, pay करो, and then we'll see if you get the other loan? Is it like that, or?
Yeah, it's only
Or
one loan per customer outstanding account, but we do recur, of course, once they've repaid.
all right, perfect. So my last question to this is that how do you control your default rates? Like, how do you make sure they don't go above a certain standard?
Well, that's the secret sauce, and that's what everyone is actually trying to focus on. And we have succeeded to a great extent. We definitely do face the defaults, but the good thing is that we've actually brought it down to a point where we are now happy about where things are. And how that's happened is, through this entire learning that we've actually had through lending since 2018. That we've been doing. The algorithms have learned across time. As the algorithms are exposed to more data of different sorts of customers, there are different pieces to learn from. And so that's what we're focusing on. And we are evolving our credit scoring piece and the data science piece every day. So yeah, that's the focus right now.
All right, thank you so much. Zainab, do you want to take over from here?
Yeah, okay. So, with all of that, I think I want to sort of move the conversation towards what you see in the future as to where you think things will go, as well as where the general Pakistani microfinance landscape is going. So, with that, my first question in that section would just be, like I said, very literally, just where do you see the finance landscape going? What trajectory do you think it's on?
Well, Tez, we have high ambitions for Tez. Uh, so we are growing steadily towards that full stack neobank vision. Uh, we well COVID actually, I think, has been quite a blessing in disguise for us. We have, launched some new products in terms of lending. We are now getting into merchant lending, via our own platforms and with our partners as well. So that's something that we are focusing on. And the coming years, we are focused on expanding that book. But also, interestingly, we've gotten a lot of interest from the financial players from our data in our data science piece. And so I think that's something that we hope to capitalize on and help the sector understand whatever we've learned. We would want to help out the financial institutions to learn from our learnings. So that's something we're focusing on as well. In terms of the overall financial ecosystem, I think uh, the good thing is that we are going in the right direction. um, there are lots of advancements that are happening, particularly on the digital side of things. Initiatives like the RAS platform is something that I think is a great step into this direction. And I think for a lot of players, be it the conventional banks, the fintechs, NBFCs, all these players are actually, if used rightly, it can be a very, very powerful ecosystem that could develop for the overall financial inclusion landscape. We saw this in different parts of the world, how the unified gateways have actually operated, and the impact that they brought in. in countries like Thailand, in countries like India. So there's a lot that's happened, and we can actually take those use cases around the world and capitalize upon that within Pakistan as well. And it's good to see that we have that evolving. Um, yes, there's also I think lots that has to be done if we want the sector to evolve at a state where we want to see it at. So definitely there need to be much more openness in terms of some aspects of the regulatory agencies. When I talked about NADRA, the credit bureaus, having more centralized systems is something that could actually help that financial ecosystem. And I think collaborations is definitely they are and should be on the horizon between the incumbents and the new entrants, because there are lots of new, very exciting technologies that are coming into the play that could actually help this financial inclusion landscape. So I think definitely it's a very positive overview overall that I see, and a prospect that I see for the financial inclusion landscape in Pakistan. I just hope we reach it faster than we otherwise would have anticipated it to.
So I think that all of this sounds very like abstract, right? Like, so you see growth and you see this sort of, development. But do you particularly have like a tangible goal in mind, especially for days where you'll be like, okay, if we reach this point, though here I'm satisfied with like the level of offerings that we have or the reach that we've sort of gotten to.
Yeah, I think that's a tough one to answer. Of course, we have targets. So we're targeting, reaching 3 million customers within the next 3 years. Um, but whether or not we'll be satisfied with the fact that, oh, this is it, I don't think so. I think human beings are they're ungrateful species. You always want more. But I think for us, a level of success for us would be, and ultimately, I think this might sound very, very, um, it might sound unrealistic, but I'd say for Pakistan at least, the goal would be having access to financial services as easy as having access to a mobile phone. That for me would be the true essence of success.
So my next question is that I'm sure you've read articles such as Pakistan and Asian Tiger by 2050 and the next digital revolution is centered in Pakistan. But very realistically, I mean, if we compare Pakistan to other South Asian countries, like especially India and Bangladesh, like just from the top of my head, a figure, India has 61 unicorns, $61 billion valued startups right now, and Pakistan has right now zero. So where do you think like Pakistan lacks in this ecosystem of startups and especially fintech?
Like here, there, there's a lot that needs to be done, particularly in having a more conducive regulatory environment in getting funding. Number one. Now, recently the state bank has brought in some changes in foreign exchange on the foreign exchange side of things. So for the longest time, getting funds into Pakistan in these entities has been very tough. Another very important aspect has been the repatriation bits. So you see a lot of these startups that are registered, in other countries where regulations or fundraising funding is definitely is relatively easier. Uh, and I think where India has actually excelled is not only because of the funding, but also because that funding has come into companies where there was a lot of growth potential. And that growth potential actually came in from the ecosystem. For example, UPI had a huge impact on the fintech landscape. And they've done a great job. Hats off to them. How they've evolved, and the kind of number of transactions that these guys are doing on a daily basis. They're doing it in millions and millions of transactions happening on a daily basis, billions of dollars worth of transactions that are happening on the UPI right now. So that's the kind of traction that you actually need, within the ecosystem over here if you want more and more investment to come into play. Set aside, having a conducive environment for the investors to come in. So yeah, it's not only a one pronged story. You need to really build that ecosystem for the players also, so that they can actually achieve multiply growth, and that critical mass is actually achieved for them to actually attract that kind of investments. And I'll just give an example. For example, when we approach investors and we've approached many global investors. Uh, One of the very important things that these investors actually look into is the revenue. For unicorns, revenue is one of the most important aspect, and they actually, you know, they're in millions of dollars when you start thinking about it. For us, most of our companies are not there. If you really want unicorns, those revenues will actually come in from transactional activity. That transactional activity will come in from a conducive environment, and of course, it's a cycle, but you have to start somewhere. So I think right now, in terms of the environment, we are still at a very nascent stage. There's lots that has to go, and I can actually allude to another example of data. So when you talk about, the level of data that's available to the fintechs, for example, in India, we don't have access to that sort of data to actually make those sort of decisions to include those people or transact more. India has actually made available um, an entire different domain of data. You talk about e-commerce industries e-commerce companies over there. There are different databases that are only, targeted only for e-commerce companies or e-commerce lenders. There's another transactional set of data that's available. There's banking transaction data. There's telco data. So these fintechs also have access to a different regime of data that currently Pakistan is not open to right now. So we literally have to make a lot of changes within our ecosystem and within our mindsets if we want that kind of traction coming in from investors. And unfortunately, what we see, other countries taking away that pie, countries like Bangladesh, Vietnam, Indonesia, Philippines, there are lots of advancements happening there. So we really have to move the buck faster now.
All right, that's actually very solid point, and I'm glad that you didn't go that optimistic route that Pakistan will make it. Like you gave us actually substantial things to work on as to where Pakistan exactly lacks. So, thank you for that. So, my last question to you is that why specifically Tez Financial? Like, why did you go down this path of becoming a like? I would say that it's a kind of a social need for the art because the way you described it within this podcast as to make making sure that people who are underbanked are meeting their basic needs of medical, of like basic like getting food onto their plate. So why this social entrepreneur path? Why not something else? Why not go into like investment banking? Because from my understanding, you do have that kind of experience. You're a finance graduate and you've done the CFA. So why not like go into like different areas? Why this particular was it a sense of moral obligation or nationalism?
I honestly, I think I've been very lucky in the experience that I got. I actually got into corporate. So I started off my career with credit ratings. But I think when microfinance happened to me in credit ratings, it literally changed um, my calling. So just to give you background, I never wanted to be in the finance field. I wanted to become a doctor. I also got accepted into medical school, but it was a turn that I took because of some personal reasons, and I'm happy that I took it. So I think for me that sense of servitude was always there, and for some reason I think microfinance in this field of finance overall was probably the closest to my link to that servitude. And I think it made sense to me not only in terms of a calling, but also in terms of you know uh, the field that was being served. So it's definitely finance, but it's also finance for the masses. And I think while there's a challenge there, there was someone who actually had to meet that challenge. No one it was actually an open horizon. No one was actually working on it. And for us, it was a no-brainer to actually come into something where there was such a huge need, and it still wasn't being served. So I think it was a bit of a calling, and I think when you said responsibility, I feel that sense of responsibility. Even if I'm not supposed to, I don't think one person can actually change the game, but I think maybe one person can at the end of the day change the game if there are others following them. So yeah, for me, that's the reason why I got into this.
Or
Okay, I think that sounds good. That Yes, sorry, then I think we've covered all the questions that we had. So I just wanted to say thank you so much for your time. This was incredibly helpful, and I got to learn a lot as well. And Daniel, if you have anything to add.
No, I just really want to thank you for your time, for like meeting us on such short notice, and for answering all our questions. It gave us a lot of insight onto how the fintech industry within Pakistan works and the future of Pakistan, at least within this region. So, do you have any questions for us or anything?
Well, thank you so much for having me. It was a pleasure talking to you both. And it's great to know that you guys you're very well aware of the sector itself, and the kind of work that you guys are doing. The good thing is that not a lot of people even working in the sector are aware of the kind of questions that you ask. So great to see, and continue this hard work. And I hope younger people like you step into this space even more, and make a difference.